Chapter 6, Master Budget and Responsibility Accounting, Part 2, Operating Budgets. Okay, we just discussed, what the master budget was, what its purpose is in an organization, and what the benefits are, and then what the advantages of budgets are. And now we'll look at the operating budget and its supporting schedules. And this is the main thrust of the chapter. I've got basic formulas in here with examples, right out of the textbook, but this is the kind of chapter that you need to do a lot of practice problems on, so you get all this budgeting stuff back in your head. So a budget, again, quantitative expression of a proposed plan. It coordinates what needs to be done to implement the plan, and the thing of it is, it includes both the financial piece, financial and non-financial aspects, and it's a road for the company to follow. So the operating budget begins with the revenues budget. It includes multiple schedules and concludes with a budgeted income statement. Now the financial budget has the capital expenditure budget, cash budget, and once you've got your cash figured out, you can complete a budgeted balance sheet and then a statement of cash flows. Now the basic steps are beginning with a revenue budget. It's based on expected demand because demand for companies' products is invariably the limiting factor for achieving profit goals. And the next logical step is to plan the production so that the product is available when the customers need it. The number of units to be produced is the key to computing the usage of direct materials in both quantity and dollars. And this will be based on quantity required for each unit to be produced from the production budget. Okay? And then to create the budget for direct manufacturing labor costs, management estimate wage rates, production methods, process and efficiency improvements, and hiring plans. But that's actually your easiest budget. Okay? All the work is up in here, right around there. After the labor is done, next step is to do the manufacturing costs overhead, and managing overhead costs is both challenging and important because of the required understanding of the activities required for production and the cost drivers of those activities. All right, so we've talked about overhead all semester so far, and when you're at work, it never goes away. Inventories are essential for proper customer service, and they play an important role in the determination of the budget. Recall that the production budget included a determination of the targeted ending finished goods inventory. And cost of goods sold then is calculated by adding the additional production costs to beginning finished goods inventory and then subtracting ending finished goods inventory. Non-manufacturing costs are also included in the operating expense budget. And formats can differ for the budgeted income statement, but generally information from several schedules create the budgeted income statement. So let's look at some of these steps. The main formulas and the main formats that you need to know would be, first of all, to forecast revenue. Because forecast revenue, you need to know the order that these happen in. And then for problems in that, you want to have an outline in your head. Now this does a sideways one here. This is the way it is in the textbook. Personally, I would have it go up and down, but they've got two different products here. So we've got 50,000 units at $600 a piece. These are their total revenues. All right, if you were in an organization, this would be done separately for each month, for a 12-month budget. And that is your revenue forecast. That's all you need to know. But to support the revenue forecast, we've got to figure out production. And the budgeted production is equal to sales plus target ending finished goods inventory. You don't want to end the year with nothing on the shelf. Okay, you have to have some finished goods inventory. So we take the budgeted sales plus desired ending inventory minus beginning inventory, and that's what we have to produce. All right, so you want to get this in your head. This has got to be something that is just really clear to you. Budgeted sales plus target ending inventory gives us required units, less beginning inventory is units of finished goods to be produced. Okay? All right? So sales plus target ending minus beginning is production. That's what we're going to produce. Now, in order to support production, you've got to buy direct materials. So this is another whole issue. And in the example in the book, they're building tables, and we've got red oak and granite for material. And what they've come up with here are the direct total quantity of direct materials to be used. All right, this is what they need. 60,000 units and 10,000. Okay, so then the cost budget would be some of it is going to come from beginning inventory, and some would be purchased and used this period. Okay, so these would be direct materials used this period. We'll see how the problems go in this. Okay, this is kind of an unusual format. And here's the purchases budget. The purchases is these are the materials used. This is what we need, 840 and 440 square feet or board feet. Add target ending inventory. Here's our total requirements. Less beginning inventory is purchases. Okay, so we're going to use 840,000 in production. We need so much ending inventory, right? So that's everything that we need. We can subtract what we had on hand at the beginning, or beginning inventory, and this is what we've got to purchase. Now the amount that we've got to purchase, we can hit that times the cost per board foot and get our direct materials to be purchased this period. Okay. And here are just a couple other ones. Here's the direct labor cost budget. This will be real easy. So many units times so many direct labor hours per unit give me total hours. There's our wage rate. And then this is their overhead cost budget. And they've got it broken down between variable and fixed costs. Okay, which is pretty typical, and you'll have different cost drivers in here that'll make up what the overhead is. Okay, now the schedules that we just discussed and the budgeted income statement are complete. Then you've got to complete some other ones to finish out the balance sheet and the financial section of the master budget. So that would be a capital expenditures budget, and capital expenditures would be like fixed assets. Okay, a cash budget. So cash budget has total cash receipts, less cash disbursements. We've got a required cash balance. So we would have to add the, add the requirements to where we are, and then see if we need to borrow money. After we're finished with that, we can do a budgeted balance sheet and a budgeted statement of cash flows. And here's this illustration, shows the relationship between the schedules that we discussed for both operating and financial sections of the master budget. And you can see that the revenues budget begins the process and informs virtually all the schedules that come later. So this revenue forecast is really important, and that's where it's good as a management accountant to know what everything you can know about the business. Okay, that's what's really most important. Okay, there's production. Here are materials here. We've got direct labor and overhead, then cost of goods sold, R&D and design costs, marketing, distribution, budgeted income statement. Okay,